Good morning, everybody. Rob Barnes with Integrated Insurance Consulting. Today's topic is disability insights. This is the last of our spring presentations and look forward to presenting again in the fall, which we'll address at the end. So I'm going to get right into today's material and we'll move on. When you ask most people what their number one asset is, you'll often hear things like their car, their house, their IRA account, or certain piles of money. But the reality is, for those within the prime working years, the biggest asset you may own is you and your ability to work and earn an income moving forward. What we know about disability coverage is that it's the most underutilized product in the industry. Only 1/3 of the workforce has this type of coverage, and less than 20% of workers have obtained coverage outside of the group plan that they might have. So today we're going to be discussing the common misperceptions. We'll share some statistics and perspective. We're going to look at the group policy, disability policy deficiencies. We'll share the components of individual disability, what makes a good policy and what different policy riders and such you need to be aware of. We'll look at high income earners and business owners and how to protect them better than where they are today. And of course, we'll share some tools for success and preview the toolkit that we'll give to all attendees today. So when we look at the different misperceptions out there, I've heard them all through my career. It won't happen to me. I'm already covered at work. I've got Social Security or workman's comp. I don't need disability. Hey, my spouse works, or hey, it's just too expensive. And all of these might have some validity to them, at least in the client's eyes, but let's address them individually. So the idea of it won't happen to me, what we know is for those entering the workforce, they have a 25% chance during their working years to have a substantial disability. And if you reach age 45, that only increases, that you're now 40% likely to have some type of disability. And what we know about individual and group claims is what the averages are. They tend to be on claim for more than 2.5 years. So imagine 2.5 years without a paycheck, or with a substantially lower paycheck if you don't have the right amount of coverage. So for those thinking that they're already covered at work, what we know is that 35% of the people are, and so the rest are maybe not aware of what their benefits really are. And even if you are covered by a group plan, you need to be aware of the deficiencies. If the disability is paid by the employer, that makes it a taxable benefit when you become disabled. And so you could see your paycheck as low as 40% of what you normally get. And for high income earners, it's even more important to check this because you often have caps that could cause them to get even less than 42% if they become disabled at some point in time. Again, being around the insurance industry a long time, I've had some people tell me that, if I get hurt, I'm going to drag myself to work tomorrow no matter what, and I'll make it a workman's comp claim. Well, you don't always have that wherewithal to do. And what we do know is that 90% of claims are due to illness, not accidents, as people might think, and less than 1% of the claims are covered by workman's comp is the reality of things. And for those relying on Social Security disability, we know that they decline a significant portion of the initial applications for people. And even if you do get approved, the typical benefit is only $1,200 a month, which may not even pay the mortgage. Now, this objection is something that has validity to it. My spouse works. And so we want to drill down a little bit and make sure that, is the household running on both incomes? How vital are both incomes of the household? And so are you saving all of your spouse's income or not? And if somebody loses a job, they might not be able to retain their disability. And I know this is a rare occurrence, but going to an accident thing, you're in a car crash and you both get disabled. Now's the time to know how good your disability is. Or I should back up there, excuse me. Claim time is not the time to find out how good your disability coverage is. So these are things to discuss and document with your clients. Now, the too expensive thing, I tend to be direct with people and, what's the cost of not having the insurance and needing it versus needing it and not having it. Um, I think I said that right, excuse me. What's the cost of having it and not needing it versus needing it and not having it is the right statement here. So we'll share with you in your kit and a little bit later the formula, but essentially to protect your gross income. So if we're protecting $100,000 a year of income, the benefit's generally going to be $5,000 a month or $60,000, and the cost is going to be somewhere between $2,000 and $3,000. That depends on all the riders, your age, your occupation, and so forth. And for those that just are going to not spend the money to be protected, great, and you're walking through life without that safety net. And what we know is medical issues tend to be a large reason why homes are foreclosed on. And more than 500,000 bankruptcy each year happen from medical things. And that usually means that your income stopped there as well. So some of the other statistics that we're aware of, back in 2021, there were 44 million people that were considered disabled. 40% of those were in their working years. And there's a slight difference between the average claim for group and individual, as you can see, but generally around 2.5 years. And 1 in 8 disabilities is going to last for 5 years or longer. We all see people in wheelchairs and worse, and that's something that we have to be concerned with. As far as some additional claim stats, this might be a little bit hard to see, but if you just focus on the different colors, those are age groups. And the one I want to point out is the orange. I agree that it's all downhill health-wise once you reach age 50 and beyond for people. And the statistics bear that out, that there's a significant increase in disability claims when you reach between ages 50 and 59. And think about it. This is the guy on the basketball court who thinks he's 25 still and tears an Achilles heel or something like that. Or it might be your first heart attack that you have, things that will cause you to be disabled. So don't think about getting rid of your coverage until you're real close to retirement or have a big pile of money would be my recommendation there. The top 5 reasons are on the board here. I don't show me while I'm presenting, and one of the reasons is I sit on a ball. And the reason I sit on the ball is it keeps me, I have herniated discs, and this keeps me away from the chiropractor and, other workout routines that compensate for a bad back, if you will, and be in an office for that matter. Cancers and accidents and mental disorders and cardiovascular. These are some of the other main reasons that total up more than half of claims is the reality there. So be aware of that with people. And this is why it's important to screen people's health before you start quoting insurance, because if you had major back issues and you're applying for disability, I want to let you know you might be declined, or you certainly might have your back issues waived on the policy and be covered for all the other things. So perspective here that I'll share, where is your safety net in life? Do you want to walk the tightrope of life without one? It's really your personal decision and how you counsel your clients. But want to make sure that you accurately compare and you try to get past some of the initial objections to disability coverage that your clients might raise with you. And one of those, so this is a 40-year-old female. We're showing a premium of $2,900. And sometimes people just compare this to the 5,000 a month benefit. Well, you can't just compare it to that. You have to compare it to the annual amount and even the total amount. If you had a 5-year claim over 5 years, your premiums would have been 13,000, but your claim would have been 300. So the 13,000 over 5 years is helping protect a much larger amount than what it appears, depending on the length of your claim. And if you were permanently disabled, going all the way to age 65 on a policy, without inflation, you're spending a million too. And if the disability occurred within the first 5 years and you had the cost of living rider, your total premium outlay in 5 years would have been 14 grand, but your amount of benefit would be 1,600,000 if you had a permanent disability 5 years into the policy. So these are just things to make sure you compare that. It's not just the month or the year of benefit, it's the cumulative amount that the insurance company has on the line. So one thing just to note for all the ladies on the call, that pregnancy is generally not covered on individual disability. You will find it covered on group stuff, but I've had people call up and want to get coverage because they just found out they're pregnant and they're thinking that when they're off work, it'll be a disability claim, and just want to make sure that you're aware of that. And speaking of females, and when I was building this presentation, within a few weeks of making the presentation along the way, I had two different interviews and they turned out two different ways. And I want to share that because this is kind of the thinking that people get stuck in. So executive one was a single mom. She had a rapidly growing income. In fact, she was moving out of the state to open a branch in another state. So she was buying a big house, had just bought a nice car, all these things. And it turns out her group coverage was only $3,000 net because it was a taxable benefit. So we're like, that wasn't even the mortgage on her new house. And so how was she going to pay the mortgage if she became disabled? And the pricing on the disability quotes that we were giving her were kind of close to the new car payment she was just paying. So she really had a lot of sticker shock. And I can't tell you if she ever bought since, but she wasn't buying that day. And I hadn't heard back from the advisor on the issue. And then a couple weeks after that, I received a call from an advisor that I work with, his client. He had her call me direct, and she was telling me she's doing very well in her business. She was the breadwinner in the house. The husband was raising the kids, and when she was first hired at this firm, she opted out of group coverage. Well, now recently, she had a diagnosis of multiple sclerosis, and she was trying to get added to her group plan now, and they declined her. And so when she told me, and I told her, well, I'm sorry, but with that designation, I can't get you disability insurance in the real world. And she was a little bit scorned about that, but it's one of these things that we can't have a viable business if we take people on once we know they are going to have a claim. So, what I reflected on after this was the difference between the two things. Again, is it having it and not needing it better than needing it and not having it? And so what I did is I just took a reflection. I go, I wish that I could have put those two young ladies in the room together and let them talk to each other, because they were seeing things from different perspectives at that point in time. And if they had a longer term view, maybe they would have done something differently. So the reality of today's world is less people are selling insurance. That's good for me, but it's not good for the industry. And everybody wants to manage money and do comprehensive planning, but less people are trying to protect their clients. And so if you don't do this, if you don't bring up disability and discuss this with your clients, who's going to, is the question. So I just believe it's our job as advisors to discover what they have, discover and recommend what they might want to have additionally, and make sure you document it. We can only lead them to water. If they drink it, great. If they don't, just document it so that they don't come back and try to sue you later. dealing with clients, as you know, is challenging. And so I'm always trying to get inside the other person's head and think like they do to help them see something. You know, having aha or holy cow moments with our clients, I think, is important about things. And so this acronym of DIPS, this was developed after the yummy Jelly Belly dips. Their jelly beans are so good, but when you dip them in chocolate, it's even better, is a way to say that. But I came up with the thing of, are they in denial? Are they ignorant of the issue? Do they not understand? Are they just procrastinating? Are they stuck, or maybe even stubborn or worse? And so as I reflect back to those two young ladies, executive one, I think, was in denial. Not necessarily that she couldn't get disabled, but she didn't expect it to happen anytime soon. And she wasn't going to take on another payment to be better protected, feeling that she was going to be okay. And yet, executive two, perhaps you could say she was ignorant at the time she signed up for benefits. She didn't know how important it would be maybe later in her life to have that disability coverage. And now, unfortunately, she was stuck, not being able to get coverage. So, trying to sit back and reflect how to overcome these issues with our clients is a challenge, no doubt. And just want to make sure that I'm getting through to people so that they do understand. And so sometimes we have to think outside the box and we have to present things in a different way so the perspective is comprehended by clients. So one of the things you might do is offer them, a role play situation. Hey, Mrs. Jones, there's two jobs that you could take care. One has 100,000 salary. There's some incentive pay for you. We'll give you health insurance and a 401k. The other one, we're going to pay you 97,000. We're going to give you the same incentive pay, health insurance, 401k. But if you're unable to work due to injury or illness, we're going to continue to pay your paycheck. Now, what is this example? It's the price of a comprehensive long-term care plan taken out of the salary thing. And when you go from this perspective, a lot of people are going to choose scenario two. But we go on. You all remember the golden goose, right? Lays the golden egg every year. Well, Mrs. Jones, if you own this golden goose and every year it laid an egg worth $100,000, what would you want to insure the goose for? And then you have to come to grips with Mrs. Jones, there is no golden goose. And in fact, you're the golden goose. You're the one making 100,000 a year. And so you wanted to insure the goose, but you don't want to insure you, and you are the goose. So again, just a little bit corny on this one, but trying to get through to people to make sure that they understand and make an informed decision or take the risk of not being properly covered. It's up to them at the end of the day. We can only do so much as advisors. So let's move on to group long-term disability insurance and the deficiencies. Generally, there's caps. They often don't allow for portability. The pricing is usually banded in 5-year age bands and is going to change down the road. And most importantly, the definition of disability is different for different group plans. And it's important, again, the time to know how good your plan is not claim time is the point. Are you going to be taxed if the employer is paying the full benefit? The benefits with, excuse me, if the employer is paying the full premium, the benefits are going to be taxable. And sometimes you just need to layer or supplement what they have to bring those benefits up. And so reading the plan details matters, but of course the client's got to get you that benefit book, right? And share it with you so you can look at these things. And it's not just a matter of believing them that, hey, they're covered at work, right? It's, okay, you're covered, but how much are you covered for and how good are your policy benefits? Those are things that we have to discuss with them. So we'll cover the these along the way here in the next few slides. So the reasons to have individual disability is maintain your current level of income, a lifestyle, protect your savings, your family, and your future. So what do we utilize when we're designing an individual disability policy? We're going to cover a couple technical things, some riders and features, and we'll share that rule of thumb, which kind of already shared, and talk about high income earners here. So the words non-cancelable and guaranteed renewable sound a lot alike, don't they? But the reality is a non-cancelable individual disability policy means that the rate is guaranteed for life. They can't increase it. And the words guaranteed renewable are a guaranteed renewable contract, as it sounds. They can't cancel it on you, but they could adjust premiums down the road. So moving on, the definition of disability matters in a big way. There's any occupation, which is what we find in some basic group plans, modified occupation, transitional occupation, and own occ. And so on a continuum, you can see that own occupation is the strongest definition you can have. My policy is a UROC policy because if I can't do this job, I'm not going to go flip burgers at McDonald's or something there. And even if I were in a wheelchair, I can sit at my desk and work all day. But if my mental ability or communication and senses and so forth are disturbed, I might not be able to work. But for me personally, if I couldn't work, I have my paycheck protected, but I'd probably do more charity work. I'm involved and serve on a board of a charity, and that's my style. Some people who can't work in their main job, they have to work and they're going to want to work somewhere else. And if you do that, you need to either have a transitional or an own-oc policy. So own occupation is a little bit overblown. Not everybody needs that. You think if I can call you all office wimps like me, where we're in a white collar job, and as long as we have our faculties, we can probably get along. But a surgeon who performs surgery as their main income, something happens to their hand, they're out of work. And so having own occupation means they could get their full benefit and do something else along the way. So maybe they can teach or do something around that, but they can't actually perform the surgery. So there are some jobs, a dentist would be another one, right? If they can't work with their hands, you might want own occupation for there, but a UROC or a transitional OC will work well for a lot of people. What we want to avoid is the any occupation. That's the one where, hey, if you can't do what you're doing, they'll make you go work somewhere else. They don't care if it's a lot less pay or less challenging, whatever. So these are things to look for. We often find ENEOC in certain groups, and then better plans will at least have a modified occupation clause in there. So reading the benefits book and finding out the definition of disability that they have in their program is important. So some of the riders and features when building an individual disability plan, residual and recovery. So think about this. You don't always become disabled overnight, right? You might slowly deteriorate with some condition or disease, and then you don't recover overnight either. You might take time. And so I use an example here for you of being in a car crash and a broken back, right? So that is an immediate disability, no doubt, on the front side. But the recovery could be long and hard. So maybe I can only, I'm laid up in bed in traction surgery after surgery, and I want all my benefits. But when I start going back to work, maybe I can only sit up for a couple hours a day, and that's going to hinder my ability to be productive. And so some people myself included here, if I'm a small business owner, right? If my business is deteriorated and I'm not here, you can't wait for me to recover a year and a half later from my back situation to protect your clients. You're going to have to find another insurance person to work with. And that could deteriorate my business. So the recovery and residuals help me keep my paycheck where they are. If I'm working less at the start, it'll fill that bucket for me. If I'm not making the same until I rebuild my business because I lost accounts, it's important. Now, if you're at a large firm and there's a lot of planners, this might not be as important for you because somebody can step in and fill your role. But when you're self-employed, if you will, when a lot of the business depends on you, I highly recommend, even though it's a rider, to me, it's an essential part of a quality policy to have the residual recovery rider. Well, so building on catastrophic benefit, this is really a long-term care rider on top of your disability. So think about it. You're in a car crash, you're waist down paralyzed. Maybe you can still operate and be okay. But if you're neck down paralyzed, now not only do you not have the ability to earn your paycheck, but you probably have an added cost for care. And so this isn't a rider that doesn't cost much to add because it's a rarer situation, but they happen. We see these people, and if you want a more comprehensive disability plan, you'll add that rider. And then cost of living, the younger you are, the more it makes sense to have a COLA rider on your policy. And maybe, when you reach 50, 55, you've saved a lot of assets and stuff, you might remove that cost of living rider on your policy because it's not as important. You don't have as far to go without that. And so we shared this earlier as I rambled on, but this is a quick rule of thumb. We'll include this page in your kit so you know. But generally speaking, we're not going to allow you to get your full paycheck. And the difference and the divide is the difference of taxes and social security and stuff. So generally speaking, 100,000 salary, they're going to let you get 60% of that or $60,000, maybe a little bit more with some carriers. And now that's $5,000 a month benefit or 60,000 a year. And the premium is going to be 2 to 3%, not of the 60,000 benefit, but of the 100,000 income we're trying to protect. So what I find, I do work with licensed agents as well as fee only and fee based. And some of my licensed agents, they spend their time on getting illustrations and they don't utilize this rule of thumb with clients. And don't make the process about getting an illustration and a number. Make the process a discussion about the importance of walking through life with or without a safety net for your income and what happens if you didn't have it and need it someday. That's the discussion to have with your clients that's vital from my perspective. So I'm going to pause a second for those that might have come in late. We need you to log 50 minutes. So if you came in a little bit after the start of the hour, make sure you stay on through the Q&A. Our system does record these things. I recognize somebody raised their hands, but we'll address your stuff in the chat box at the end. I keep flowing here, so sorry about that, but that's how we work, and we can always have one-on-one discussions. When you log off today, there'll be a survey in your browser. We appreciate you filling in the full survey when you can, but we will be sending a repeat of this 24 hours from now. You'll get an email. So if you have to leave immediately after the program's over and you can't fill in the survey, you'll get a second chance. And for those who filled in the survey today, we'll give you another chance. For those who filled it in today, you can ignore the email tomorrow, excuse me. And we appreciate you filling in a full survey, but at least please give us your CFP code or let us know if you're not one so we can file in a timely manner. So let's move on to high income earners. This is probably a real big thing because my understanding with fee-only advisors, you generally work with higher income people, higher wealth people who can afford your services and need your services, no doubt. And so the one thing that we want to be aware of is a lot of group plans reverse discriminate against their best people. What do I mean by that? Well, with group life insurance, you might have a program that gives you 3 times your annual salary, but it has a 250 cap. Well, that's great for somebody at the firm making 50 grand a year. They're going to get their 3 times. But the person, the corner office lady making 300,000 a year, she's going to have the cap of the 250 and not get the full amount. And a similar thing happens with disability and group plans and reverse discrimination. If you have a group plan that gives you 60% of your income, but it has a $10,000 monthly cap, then unfortunately, we're not going to be able to we're not going to be able to get your full 60% of the 300,000 because of the cap. And so look for these things. That's why you can't just take a client's word, oh, I'm all covered, I've got stuff at work. Well, they might have a good plan, but where's the cap? And so industry limitations happen in here. We use specialty carriers as well when we get to high income people because carriers will generally only accept so much risk in the disability world. So go back to that surgeon that we mentioned earlier. Surgeons might make 300,000 or up to 800 and a million and more through the year. And excuse me, that is there. They have large incomes is long and short of it. And a typical one carrier will usually retain 20 grand themselves, but they'll participate with other carriers. So if I needed $35,000 a month to cover somebody, I'm probably going to have to use 2 carriers because one alone won't accept the full risk is the long and short of it. And then we can have specialty things, not working and not funding your 401k has a cost for what your retirement might look like down the road. For people that are filling in higher risk occupations and such, there are some policies that'll offer a lump sum disability, something that might pay the house off or so. And then when you can't get other disability, maybe critical illness, it's not exactly the same thing, but it provides money at a time of need is the point. So if you have a radical cancer later, you can't work, a critical illness policy might pay some benefits that can help either in lieu of or in addition to your basic disability. So moving on, this is a quick glance at the replacing your 401k and the matching that you might miss. So if you become disabled at age 40, the contributions cease. What's the loss? Well, you could lose, this is using an 8% rate of return, might be a little aggressive, but you could lose over $3.2 million that won't be in your retirement plan later because it wasn't funded along the way. And we can add riders to disability policies to ensure for 401k deposits, believe it or not, and matching. And then certain occupations. I know my chiropractor was hard to get insured. Brokers and floor traders, people in the entertainment industry, certain medical and dental arenas, and pilots. These are all unique disability scenarios where we often have to go to specialty carriers that work within these arenas. Okay. Protecting the business. I will state right now that we're building a brand new presentation that will debut in the fall. It's going to be all case studies. Most of them are ones I've been directly involved with and know the outcome or the ending and details along the way of what we did and why we did it and all those. But it's going to focus on business owners. So you might see a disability play in there as well. But I'm working right now with several business continuity cases. And in this one case, 2 brothers in their 40s have a very successful business. And we asked for their buy-sell document. They have articles of incorporation. They're very vague. And they came to us to get some life insurance, to be clear, but they have absolutely no protection for business disability situations. And so we're discussing and educating what you could do to better insure yourselves. From my perspective, I look at everybody I meet. There's three outcomes. You're either going to live, die, or become disabled. And if you live, in the case of them as business owners, they aspire to perhaps sell the business someday and cash in the chips. That'll be some of their retirement. They're going to save along the way too. If they die, the life insurance is there, and then the disability is things like this, and or perhaps some long-term care, right? It depends on the severity of the disability event that could cause also having a need for long-term care expense. So there's overhead expense, there's loan protection, key person replacement, and buyout, and we'll work through these here. So again, just pause while I breathe here and take a sip. If you do have questions, add them to the chat box and we will get to them at the 50-minute point in the presentation, roughly. Thank you. Overhead expense. This, as it sounds, any business has some kind of infrastructure costs, salaries, utilities, mortgage, rent, all those things. And if somebody's disabled, we can not only replace their paycheck, but we can have benefits to pay for added expenses, because often when somebody key to the company, a key rainmaker, is disabled, the business is going to suffer in revenue. And these are things that can help in time of need. Now, through the years, this happens more with dentists that I've had versus any others, but nowadays you have firms buying out other firms in the consulting business, and certain architects or CPAs, medical professionals, will buy out an existing firm versus starting from scratch. And so that loan is something that we can protect for, right? Because if you become disabled, you've got to not only operate your own house, operate your own business, but you got to keep paying on that loan. And so when you're purchasing a practice or a building or equipment, we can add riders to disability policies to cover that note as well, to make sure, again, that everything's copacetic along the way. For key person replacement, this is something that we're looking at with these two younger gentlemen that I mentioned right now. And the reason we are is that, they were going to be minimalists on their life insurance. And I said, you might want more life insurance than just the value of the business, because you're going to leave the other partner here without you. And you were adding to the business, so revenues are going to suffer. The business could suffer. And so having extra protection, and it's the same thing with a disability. It's one thing to have that person who is disabled. It's one thing to have their paycheck replaced. But now, depending on the length of the disability, we're either going to lose revenue, perhaps, or we're going to have to hire somebody temporarily or permanently to replace that person who's disabled that was significant to the business. And so key person replacement, just in the life insurance world, key person, you can generally buy 10 times somebody's salary. But with disability key person, the rule of thumb is 3 times salary, just to give out some of that insight of, so we're looking in this one case that they should have the maximum key person as well as some DI buyout, is what we're recommending. And that's the next thing on here, is DI buyout. So I have stories, lots of them, not only ones of cases that I've been involved with directly, but all the advisors that I work with. But I have a story from when I was growing up. I used to go to work with my dad every once in a while, and there were two brothers that owned the firm. And as I entered the insurance business and I look back, I believe they didn't have a comprehensive buy-sell, and I believe they had no disability benefits, because what happened was one brother became disabled. And the longer that went on and it became apparent he wasn't coming back, well, the other brother just didn't see the value of doing all the work and giving half of the profits away to the disabled brother. And so ultimately they entered a kind of a hostile buyout. And I don't know if they've repaired the relationships, but I know at the time that that was happening, the cousins were no longer talking to each other, and it was a battle of the family and two brothers. And it's a shame that it turned out that way. Counter that with an engineering firm that we've worked with for the last 15 or more years. And one of their locations has a sign on the wall that they were established in 1937. Now, I was in there for a number of reasons, including disability updates on the key people. And as you become partner, you now have some skin in the game, and they have to buy you out ultimately and such. But what I complimented them on is, the reason why you have been in business since 1937 is because you're not only working the business, but you're working on the continuation of the business. They've had us in there 3 times roughly in the last 15 years as somebody did die along the way, and people retire, and then the new CEO happens, and we have to insure them more for their position and such. And so this is the tale of two stories of how things can turn out with the right planning or not. Now, when you look at groups of people, your odds increase that somebody's going to have an issue. So if you just focus here for the second on the 45-year-old, if you have one 45-year-old, as we said earlier, there's a 40% shot they're going to have at least a 90-day disability before age 65. But when you have 3 people, the chances now of one of them at least having a significant claim is 78%. So this is the importance of business planning when you're in there. Moving on. So I want to just walk through a few of the resource pieces that we will have in your kit, along with a recording of this presentation. You'll get these pieces. The disability disconnect piece is just something that shares some stats and comparisons so that you can help educate your client about the real odds, because disability, the reason why it's the most underutilized, unlike life insurance, your chance of dying is 100%. Maybe not this year, but in life, the only for sure, because people do evade taxes. So I don't even use the death and tax thing. I just use death. That's for sure going to happen. But the disability, no matter what stats I'm feeding certain people, they're not looking in the mirror. They're pointing a finger. It'll be the other guy or girl. It won't be me. I'm too healthy. I'm this, I'm that. And again, I have stories, and we have to break through to clients and make sure they are rationalizing this a little bit more. And ultimately, it's up to them to be protected or not. So this piece from the Council for Disability Awareness shares some additional statistics for people to know. You'll find that musculoskeletal disorder in there, that's a significant cause of claims, and some other facts that you can share with your clients. And then when you're reviewing disability coverage, we have our integrated insight here, discussing some of the things in this program, but most importantly, we have our key questions. So we're arming you with the right questions to ask for group coverage and individual coverage. We're always here to help you, look at, be a second opinion or audit an existing policy, or, put our heads together and brainstorm what the client might want to look at if they want to be better protected. So, and then certainly for those who need disability, we're in business as well. And so we have a set process that we do. A lot of people are too quick to quote things and mismanage expectations and such, but it isn't just money that buys protection like this, it's good health too. So we start with pre-screening, and we also need the financial information. We can't over-insure you for disability. We need to know what occupation you're in, because some occupations are more hazardous than others. And long story short, these are some fact finders that we'll include to help you ask better questions. So I spoke a little bit rapid today, and we're 5 minutes early. So we have more Q&A. And again, if you came in late, please stay around. We need you to log 50 minutes on the call, and we will stay around the next 15 minutes. And I'm going to start getting to any of the chat box stuff that we had. Excuse me. So please do add your questions in here for the people that were raising their hands before. Maybe you have questions you can ask here. But I will go on, and we might have more silence if people don't ask more questions. But so somebody's asking, will we receive the slide deck? I don't give out my PowerPoints, but we do give you the replay so you can look through and stop on any page and digest it as you like. And it's a good question here. So for self-employed persons, do you insure for gross income or net income after expenses? We're generally looking at your gross income. And again, if we're doing business disability, right, we can cover your expenses of the business with that overhead expense policy that we mentioned as well. Okay. Um, apologize, I went a little bit quick today, so keep your questions coming in, please, and it'll make this more entertaining. Thank you, here. A couple more rolled in. Um, so can you touch on any nuance around disability insurance for entertainment professionals? I've had some direct um, interaction with these, and what I would tell you, it's really their unpredictability and sometimes their travel. So I remember we had a magician once upon a time that we worked on. We couldn't get stuff off the shelf, but we went to a specialty carrier and were able to get some benefit for them. I'm not really, I think it's just the inconsistency of their profession, and maybe this sounds bad, but if I'm not booking enough magician shows, right? If I'm that magician, if I'm not booking enough shows, maybe there's an incentive for me to become disabled. But you might say the same thing about people that sell insurance. If I'm not selling enough insurance, right? But I'm not. I don't have more insight, unfortunately, for you than that. We take one thing at a, we take case by case, and we study things accordingly. So next type of I think so. This question I think has to do with they're asking about maybe the definition of disability here, ONOC versus ENEOC, and talking about software engineers between age 30 and 40. Again, um, it really, I want you to be protected if you can't do what you do as a main job, right? So that could be the your occupation definition of disability. So, but at 30 or 40 years old, right? If somebody can't be an engineer anymore, let's say their head got hit and they can't focus and do things mentally as they used to, are they just going to collect their paycheck, or are they going to want to work somewhere else? If they're going to want to work somewhere else, do something else that doesn't take the brain power of the engineer, and they want to get paid for it, then they need a transitional or a own OC definition. So it really gets back to what would the client do at 30 or 40 years old if they're permanently disabled. Hope that answers your question. I appreciate you keep sending the questions in, and we are rounding out the 50 minutes. So if you came in on time, we're officially done. I am recording these answers for you just the same, and they'll be on the recording. But thank you for taking time to learn with us today about disability. look for our fall presentations, especially our new one that will debut. It'll be purely case studies, which I've heard from people that you like more. And it's a lot of them are ones that I've been directly involved with. So I know them inside and out, and I think it'll be a beneficial. And certainly, I know that a lot of planners, they might do well in the family marketplace, but they're less inclined to be able to manage these kind of things for business owners, if you will. If there's anything we do well, we are experts in estate and business planning uses of insurance and what we do here at IIC. So thank you for joining, and we'll sign off if you're signing off. But for those who came in late, stay around. We do have a couple other questions, or a couple other questions here. So this one I need to read and digest, excuse me. That is a good question. So curious about business owners and having multiple owners, and essentially how do you bridge the gap between owners and if they're not seeing eye to eye? Um, this is again the challenge of consulting with people, right? And different perspectives, and some people are stuck or stubborn or whatever on certain issues. And so I'm an educator at the heart of what I do, and lead you to the water and show you all the reasons why you should drink it. But if you're not drinking it, what I might do in this situation, just kind of no different than a family situation. If I have a breadwinner husband and a stay-at-home domestic goddess spouse, I want her to help me have him see the light of why it's so important that we protect his income from disability. And I think the same thing would be true that I would try to leverage. It's not, I can do the best I can, but some people just are closed books and they're not gonna, if I ask open-ended questions and they just grunt back to me, that's hard to communicate with. And so I leave it up to the other owners to put the pressure on the one that's not necessarily seeing the light to say, hey, we are buying this coverage, and so right now, in fact, I'm working, this isn't on disability, it's on life insurance at the moment, but three business owners, I have two of them in underwriting. And the third person, and they're all siblings here, the third person has not responded or reacted to any of my emails and stuff. I called the referring agent, and I don't want to go to the other two siblings and kind of rat this third one out that, hey, they're not calling me back or whatever. But ultimately, if they never pay attention to me, the other two are going to find out that they didn't apply for the insurance, and so they won't be covered, and that's not going to go well with the other two. So anyway, I just back to your question here, leverage the other people around, try to think outside the box with those things like the two different job scenarios I offered, or the thing. And I find having conversations with people, if they'll talk through and do more than grunt. Ultimately, I hit on the hidden objection or so forth, excuse me, and maybe just more conversation if they're willing to conversate and ultimately see the light. College athletes is a real good question, because they're asking, and now that college athletes can be multimillionaires even before they get to the pros, and maybe they never do get to the pros, they're making money. The problem, I have not encountered this yet, but I have to believe that only a specialty carrier would even play this game, because they're not necessarily even really employed, perhaps at the moment. They're getting sponsorships and things like that. And I don't consider being a college athlete a job, and I don't know that carriers do. So that's a new one on us. I appreciate that question. And I guess, it'll be only a matter of time before I run into some advisor that works with a college athlete, and they might be seeing. Now, the life insurance might be a little bit easier to work with, but disability, I think, would be a challenge. Not only because of the not really employed thing, but also what they're doing that has high risk in it. If you're a football player, they might exclude a disability caused by it, or you have to get something from the specialty carriers that's a contract just for you. We all have heard that think it was Betty Davis, was it, that had her, or Betty Grable maybe, that had her legs insured, because it was a big thing that made her a star. Those are the specialty contracts. Lloyd's of London and so forth can do things like that. But I think you're there with your college athlete question. And we have one more question here. We will stay on to round out the hour for anybody who came out late, and thank you again. Has the pool of disability insurance companies shrinking? Who are the major issuers in the current market? Any underwriters who are different? So, the pool of carriers has really been somewhat consistent throughout my career. A couple have pulled out, but more in the blue collar arena that have pulled out. So, like, I cut my teeth at Prudential when I came out of college, and they did offer disability coverage at that time, but I don't think they offer it anymore. It is a small group, and the main players, top of my head, I can just tell you that a lot of our business ends up either at Principal or at the Standard. But we have Guardian, we have Mass Mutual, we have Emeritus, we have Illinois Mutual, and another carrier that starts with an A that I'm drawing, but those are small specialty blue collar carriers that we use. Assurity is the name I was looking for. Outside of that, we have Peterson's, Lloyd's of London, and some others for the specialty stuff to give you who the universe is. So the only ones where, there's a few major career companies that offer disability that I wouldn't have access to because they're not in the brokerage arena. So it's a good question, and those are the names of the players in the marketplace. But as far as the difficulty of getting somebody insured, this is the difference of underwriting. I have pre-screens for disability, long-term care, and life insurance. And the reason I have three different pre-screens is the questions are different. I have to ask different questions for one versus the other. What won't kill you might disable you, or what might disable you won't kill you. So those are things to be aware of. And anyway, the long-winded answer to your question. So it looks like we've answered all. I will stay 4 more minutes, and just so you can log your full 50 minutes. I appreciate you staying around. And if you want us to speak at your firm or study group, we have an array of different CFP qualified programs. And please reach out, including this one, if you want it performed at your firm or your study group. So we're happy to speak to you. And in smaller groups, we can have interruptions and more Q&A and such.